Welcome back to the Deep Dive, powered by Talk Tickers. This is where we distill the complex world of earnings calls into actionable insight for you.
And today, we are really cracking open a fascinating one. BioRestorative Therapies, ticker BRTX.
Their Q3 2025 call took place on November 12th, and it really sets up a classic conflict.
It does. It's one of the most, high-stakes situations you see in microcap biotech. You've got this incredible, dense clinical and regulatory momentum.
Which is what you want to see.
Absolutely.
Yeah.
But it's running on a fuel tank that is, well, perpetually on empty.
That is the perfect way to put it. So our job here is to figure out which of those stories, the science or the balance sheet, the market is actually paying attention to.
Because the numbers, at first glance, are just completely contradictory.
Let's start there, the technical results.
Okay, so BRTX delivered a beat on GAAP net loss per share. They reported a net loss of $3 million, which comes out to negative 33 cents a share.
And the street was expecting worse, right?
Yeah, consensus was somewhere in the negative 36 to negative 38 cent range. So a beat.
An EPS beat in a development stage biotech. That almost always sounds like a win.
It does, until you flip over to the other side of the ledger.
The revenue side. So how do you post an EPS beat when your revenue line didn't just miss expectations? It basically vaporized.
Well, that's the core of the problem here. Total revenue was just $11.8 thousand.
Wait, thousand with a K?
With a K. And that was entirely from royalty income.
So what does that number even mean in context?
It means it's a disaster. That's a 95% decline from last year. And even more painfully, it was a 97% miss versus the consensus expectation.
A 97% miss. They were expecting almost $500,000 in revenue.
Around 460,000, yes.
So that's not a fluctuation. That's a complete collapse of that revenue stream. What was management's excuse?
They tried to pin it on order timing in their bio-cosmeceutical business.
And did the market buy that story?
Not for a second. The stock slid about 9.4% the day after the call.
Okay, so investors saw right through it.
Of course. An EPS beat that comes from just, cutting costs here and there is totally irrelevant if your revenue engine, no matter how small, is completely broken.
Because that unstable revenue just makes the fragile balance sheet even worse.
Exactly. And let's dive into that financial fragility, because that's really the gravity well pulling this whole stock down.
Your burn rate is picking up steam.
It is. The operating loss grew to $3.7 million in Q3. A year ago, it was $2.3 million.
So the burn is accelerating into a revenue hole.
Precisely. And for the first 9 months of the year, the total net loss is $11 million.
Just look at the ratio. You have, under $12,000 in revenue trying to support $2.6 million in R&D expenses alone.
It tells you everything you need to know. They need massive exponential amounts of capital just to survive.
Which brings us to the ticking clock, the cash runway. How much time do they have left?
They ended Q3 with $4.5 million in cash and marketable securities.
Okay, $4.5 million. But their negative operating cash flow over 9 months was $8.4 million.
That's the number you have to focus on. If you just, do some back-of-the-envelope math on their current burn, that $4.5 million is barely a 4-month cushion.
4 months, so they are always fundraising.
Constantly. They raised about $2 million from their ATM facility during the 9 months, and then another $1.1 million post-quarter in a direct offering. But they are perpetually on a 6-month clock.
And this situation got so bad it triggered a formal warning, right?
Yes, this is critical. The company had to put explicit language in their latest 10Q filing. They stated there is, and this is a direct quote, substantial doubt about their ability to continue as a going concern without more financing.
That going concern warning is the biggest red flag you can wave in front of an investor.
It really is.
Yet, in the middle of all this,
Yeah.
this cash crisis, the board did something that seems completely paradoxical.
You're talking about the stock repurchase program.
Exactly. They authorized a $2 million stock buyback. How on earth does that make any sense when you're warning you might not be able to keep the lights on?
It's a high-stakes, calculated signal.
Mm-hmm.
It's not really about buying back stock. They're using the authorization itself as a tool.
A tool for what?
For perception. Look, they are heading into the most critical regulatory and partnership meetings of the company's life in the next few months. They cannot have the stock looking like it's in a death spiral.
So they're trying to put a floor under the price.
Right. This buyback authorization, even if they only use a tiny fraction of it, is a PR move. It's designed to counteract the psychological pressure of all this dilution and hopefully keep the share price stable enough to maintain credibility in those negotiations.
So they're burning a little bit of precious cash to buy leverage.
That's the gamble.
Okay, that makes a strange kind of sense. Let's shift gears now to the bullish case, which is all about the pipeline. Let's start with the lead asset, BRTX 100.
This is for chronic lumbar disc disease, or CLDD, and this is where the story gets really exciting.
What's the progress?
They're in a phase 2, trial randomized, double-blind, sham-controlled, and they said on the call that enrollment is accelerating. They're now, quote, more than 3/4 enrolled.
So a data readout is starting to come into view.
It is, but the real inflection point is just weeks away.
Because they got fast-track designation from the FDA?
Exactly. And that unlocks something huge. The FDA has granted them a Type B meeting, scheduled for mid-December.
Okay, unpack that. Why is a Type B meeting so important here?
Because of what it implies. You get a Type B meeting when you have data that warrants a serious discussion with the agency, usually about an accelerated path forward.
So they're not just discussing the trial, they're discussing a shortcut.
A massive shortcut. Their goal is to get the FDA's blessing on a potential accelerated biologics license application, a BLA. If they get that, it could let them design a pivotal trial that shaves maybe 3 years off their development timeline.
3 years. And tens of millions of dollars in saved costs.
That's the key. This isn't just a clinical win. It's a financial lifeline. It gives them the breathing room that their balance sheet, as we just discussed, simply doesn't have.
And if they get that green light, management has a specific plan for the phase 2 data, right?
A very telling one. They plan to keep the data blinded and just transition directly into the pivotal trial.
Which signals a ton of internal confidence. They think the data is strong enough that they don't need to peak.
Exactly. They don't want to risk unblinding it and breaking that forward momentum. It's a very bullish sign.
Okay, so that's the near-term catalyst. What about the longer-term blue sky opportunity, ThermoStem?
Right, their preclinical program for obesity and metabolic disorders, they're positioning this as a potential long-duration alternative to the GLP-1 drugs.
A market that's projected to be worth over $100 billion.
Easily. And they're being smart, building the IP moat now. They just got a notice of allowance from the Japanese Patent Office, protecting the cells, the delivery methods, everything.
But the more immediate value might come from a partnership.
Yes. They confirmed on the call that they are in, quote, substantive discussions with an undisclosed company about a potential licensing deal.
And that kind of deal would be non-dilutive capital. It could solve their entire financial problem in one shot.
It could. And a win at that December Type B meeting for BRTX 100 makes all their other assets, including ThermoStem, that much more valuable in any partnership talk. It all comes back to that meeting.
So before we get to the market's take on all this, let's quickly go back to that bio-cosmeceutical business, the source of that 97% revenue miss. Are they fixing it?
They're trying. They brought in new leadership, Crystal Romano, as the head of global commercial operations.
And her background is important here.
Very. She was the president of Cartessa, which was their main distributor, so she knows exactly where the points of failure were in the old system.
So she's there to clean up the mess. What's her plan?
It's a three-pronged strategy starting in 2026. First, bring on new distributors so they're not reliant on just one. Second, sell directly to med spas to capture more of the margin. And third, potentially launch their own direct-to-consumer brand.
And there's a synergy with their clinical work, too.
A smart one. They can use their existing lab capacity and even some of their clinical cell lines for topical cosmetic use only, of course, to develop these products.
So they're turning downtime in the lab into potential revenue.
It's exactly what a cash-starved biotech should be doing, trying to get any operational revenue they can to help subsidize the expensive R&D.
Okay, so you have this story of a company with huge, dense, near-term milestones.
The potential fix for their commercial mess.
And yet, the market has been absolutely crushing the stock. BRTX is down 41% in the last 3 months.
While the biotech sector itself, the XBI, is up 37% in that same time frame.
That is a massive divergence.
Yeah.
So market skepticism is profound.
It is. Quant models are flagging all the obvious risks. The shareholder dilution, the going concern warning. Investors are just looking past the science and staring at that cash runway.
So management is on the call sounding cautiously bullish, pointing to all these catalysts.
But the 9% drop after the call tells you the market heard only one thing.
A ticking clock.
A ticking clock. The market believes the gravitational pull of the balance sheet is stronger than the promise of the pipeline, at least for now.
Which brings us to our final segment, our scenario analysis. And we have to be clear, this is not financial advice.
Absolutely not. We're talking about a highly speculative, micro-cap biotech stock trading around $1.08. It's deeply depressed for all the reasons we just talked about.
But it's sitting right on top of this massive binary catalyst.
The mid-December Type B meeting. That is everything. The current valuation is pricing in the absolute worst-case scenario. More delays, endless dilution, maybe even failure.
So if you're an investor with an extremely high tolerance for risk, the trade idea here is a short-term, speculative long position targeting that FDA meeting.
The logic is that any good news out of that meeting is not priced in at all.
Yeah.
If the FDA grants that accelerated DLA path for BRTX 100, it completely changes the narrative.
It de-risks the whole program.
It de-risks the program, it validates the technology, and it dramatically increases the odds of a big partnership or even an acquisition. A regulatory win like that would completely overwhelm the balance sheet fears, at least temporarily.
And you'd see a sharp, aggressive re-rating of the stock.
A big one. Conversely, if the FDA pushes back and says they need more data or a longer trial,
then the timeline stretches, the need for cash becomes even more acute, and the stock probably tests new lows, breaking below that $1 psychological level.
So it's a pure binary bet on that FDA decision. You're betting that the company's internal confidence is justified and that the phase 2 data they've seen so far is strong enough to impress the agency.
The potential upside is huge compared to the downside, which you could argue is already mostly priced in.
That's the thesis.
So, to wrap up our deep dive, BRTX is a study in high optionality sitting on top of extreme financial risk. It all comes down to that FDA meeting and whether their new commercial head can turn that cosmetics business into a real revenue stream.
And the final question we'll leave you with is this. Given that the stock is down over 40%, while the rest of the sector has been rallying, is the current valuation already discounting the worst-case scenario? Or is a 4-month cash runway just too thin to justify taking a risk before the FDA speaks?
It's a true high-stakes gamble between science and solvency. Thank you for joining us for this analysis. Remember, the deep dive provides information and detailed analysis, not investment advice.
We look forward to talking to you soon.